Hey folks, welcome to Nyay Kranti. Today we are diving more like drowning into the wild world of currencies and exchange rate, specifically the Indian rupee's roller coaster ride against the US dollar. Recently, the rupee smashed through the 85 mark against the dollar, showing a staggering 39% surge over the last decade, from rupees 61 in 2014 and 85 in 2024. So what's the big deal? Well, you are now going to have to shell out 85 rupees to get your hands on just $1. But before we jump into the core, let's break down what an exchange rate is. Imagine it like a currency swap between two friends. Me and you, where I, Lakshay, am from India and you are from the US. I want to buy a $1 burger in the US, but I am holding rupees. With an exchange rate of $1 is equal to 85.47 INR, I score $1.17 from you in exchange for 100 rupees, meaning I can buy that burger and will be left with just $0.17. So what drives these exchange rates crazy? It's all about the concept of demand and supply. If Indians are craving US dollar more than the Americans are interested in rupee, the exchange rate is going to favor the dollar. And if this trend continues, the rupee is just going to keep sinking. But wait, there's more. If the US slaps restrictions on Indian imports or imposes heavy tariffs, the rupee weakens even further. I mean, why would the American businesses bother with the rupee if they can't even buy Indian products? And then we have inflation. If India's inflation rate skyrockets while the US keeps their in check, investors are probably going to flock to the US market, which promises more reliable returns. So what's happening now? Investors are pulling their money out of India, weakening the rupee in the process. The US has already slapped tariffs on Indian steel and aluminium industries, and India is retaliating with its own tariffs on the US goods. To kickstart India's growth trajectory, the government needs to settle on a straightforward, export led growth strategy, cutting down on policy uncertainty and risks. India also needs to allow the exchange rate to be influenced by the market forces, ensuring that all firms operate on a fair playing field. Transparency and consistency in policy decisions are absolutely essential. By fostering a stable business environment, India could lure in more investment, ramp up exports, and achieve swift growth. The choice is of India now. Seize this chance, and we'll be sipping margaritas on the beach of prosperity by 2024. Miss it, and we'll be stuck in the rut of stagnation.